Now with Enbridge, having a dividend yield of over 7%. Is this safe? Now recently, Enbridge has taken a haircut like every other company on the stock market because we're in a bear market should you invest in Enbridge. Now Enbridge is a big energy company. It's like the main artery of oil and gas, serving up oil and gas across North America. Think of Enbridge like the Amazon delivery service for energy. Enbridge is the invisible roadway that's keeping our homes heated, our cars running, and our industries churning. Every time you flick a switch or drive your car, you're probably using energy from Enbridge in some way, shape, or form. Now, they're not just focused on oil and gas, they've been dipping their toes into renewable energy, getting into wind farms. Now, this company has been serving dividends like it's a casino. But the thing is, its dividend payout ratio, has been raising a lot of eyebrows. Now, I know some of you are going to be like,
oh, come on, Tracy. Enbridge has been paying their dividends for the past 27 years, okay? They're good.
Now, I agree. Enbridge has had a solid dividend history. But this is where the plot thickens. If you just look at their earnings payout ratio, it is like bonkers. That's like saying you're spending more than what you're earning every single month. Every paycheck that you collect every single month, you've been paying out in expenses more than 200%. That's unsustainable. Now, doesn't that make you wonder? Well, Enbridge has a trick up its sleeve because a lot of their clients are on fixed contracts and they're able to raise prices. Now, we got to use another metric, which is this distributable cash flow. With companies like Enbridge, which is super capital intensive, you got to look at how much income they're collecting in, how many expenses they're paying out, and what's the difference. It's like you when you go up buy a car. Sure, you look at the sticker price, but you're probably wondering, okay, I got fuel costs, I got to maintain the car, I got to pay for parking. Now that's similar to Enbridge. So the DCF takes into account the hidden cost investments in a capital intensive company. And as long as the DCF has enough money to pay out the dividends, then we're safe. And I look for a metric below 80%. Now, using the distributable cash flow, you could see that Enbridge has a much more reasonable payout ratio.
Hey, I want to do a brief pause and just share this valuable information, how to calculate the DCF payout ratio. So the first step is to go to Yahoo Finance under statistics and head over there and we'll find the current dividend yield. Now that we're Yahoo Finance, type in the ticker symbol enb.to. Then we're going to head over to statistics. Once you're on that page, you're going to scroll all the way to the bottom, and that's where you can find the dividend. Next step is to look for the DCF per share. Now, the only way to find that is to actually go to Investor Relations under Enbridge, and you'll scroll down the presentation and you'll find this information. So let's head over there right now. So we're going to go to Enbridge, go to Investors, hit the Events and Presentation. Hit that button, then you scroll all the way down. I like to look at 2023 Enbridge Day because it has comprehensive information. Then I'll download the PDF called the Combined Presentation. So I'm going to now scroll all the way down until I find the distributable cash flow per share. We found it. This is where you can find 2021, 2022, and 2023 DCF per share. Now that we have the numbers, let's math it up. So we're going to calculate the DCF payout ratio, which is simply the dividends per share divided by the DCF per share. So let's plop in the numbers. So we're going to use the dividends per share, which is now 3.22, and then divided by the DCF per share. Remember, we got that from the investor relations presentation, which is, I'm going to use the high number, which is 5.65. So then once you multiply that by 100%, you get the percentage, which is approximately less than 61%. But what I look for is anything less than 80%.
Now, before you jump in and say,
yes, I'm going to buy the Enbridge stock because it's reasonably priced and its dividend yield is so enticing.
Unfortunately, sorry to break your excitement, but there's two red flags. The first flag is its debt. Over time, unfortunately, Enbridge has been increasing their debt over time. And in a sensitive interest rate environment, this is always making me a little bit worried, okay? And I don't know how it's going to pay out its debt. Now, there's only two ways to pay down its debt. It can cut expenses, trim its dividends, or raise capital. And guess what Enbridge is doing? Raising capital. And how it raises capital is increasing the number of shares in the market, which is leading me to see this graph, which I don't like. That means it's diluting the amount of value it has per share to all the investors. Now, don't get me wrong. I'm not saying Enbridge is going to go bankrupt. It's going to disappear any day soon. It's next to impossible because it has a massive moat. It is the main artery of transporting oil and gas across Canada and the United States. And it's really hard to replace all that infrastructure. But if I was an income investor and I really relied on the dividends from Enbridge to pay out my expenses, the high debt, the increasing number of outstanding shares is something that I would get worried about. And so for me personally, I don't plan on investing in Enbridge, even though the yield is super enticing. I just don't like those two variables out there. Now, if you want to hear the latest Canadian stocks that I've been purchasing, check out this video up here. See ya.